Hello friends, welcome to another Quicken Mac video. Okay, in this video I'm going to talk about doing mortgage payments or reflecting mortgage payments in Quicken. There's a couple ways you can do this, and we're going to go over both of them, and I'll sort of explain the differences, and you can decide which is right for you. But before we get to the exciting video content, I want to ask you a favor. See if you could like and subscribe if you like my content. That really helps me out. And then also I want to point out that I recently set up some tiers, paid tiers on my YouTube channel. In the lower price tier, you basically get access to some advanced Quicken videos that are not on the channel at large. And then in the second tier, not only to get what's in the first tier, but you can also request I make a specific video to answer your specific problem. A lot of people request videos, and I got a long list of videos that would be great to make. Obviously, they take time, so I just kind of do them in the order I have. But if you join the membership, I'll bump you up to the top. Okay, so moving on to the video here. We are in Quicken Mac, and we're going to talk about how you can handle your mortgage payments. If you happen to watch the video on entering your paycheck, it's actually not dissimilar. It's kind of similar. I could say it that way too. In that when you pay your mortgage, there's multiple things happening. You are just sending out money to the mortgage company, sure, but what you're doing is you're paying, some of your money's going to interest, right? Just out the window. Some of your money is going to insurance. If you have an impound account, some of your money goes to the impound account, and then eventually that money goes to insurance and taxes, all out the window. But some of your money is going to the principal of the loan. And that money is not out the window. That money is actually going into what I call the savings account that is your house. Part of the reason I am such a proponent of home ownership is I do think it's a forced savings account for many people. If you have a hard time saving or whatever, buying a house every month, some of your payment goes to the principal and thereby increases your equity in the house. That equity is essentially a savings account that is invested in real estate. And the cool thing about mortgage payments is the way the amortization works is every month more and more and more and more is going to the principal and less to interest. And in essence, you're kind of paying less and less and less every month for your housing. But anyway, that's another video. So when we put the mortgage payment into Quicken, we have two options, or a couple options, maybe more than two. We can just say, hey, I paid the mortgage, money's gone. I know some of it's, going to my equity, but I don't care. I don't want to track that. It's too annoying. Money's out the window, and we're just going to leave it at that for now, for the information I get out of Quicken. That's the easier, quicker, and not so correct way to do it. And then the correct way is to do a little bit more work up front and then save that and kind of have it automatically enter every time. And this way we'll end up with a little bit more accurate info. But I will say, actually, I kind of do it both ways, and I'll explain what I mean in a sec. So anyway, I queued up like, a mortgage payment here. I got this example mortgage payment statement. So we're going to use that here. And the payment for this mortgage, statement is $43.39.13. And I'm in a checking account here, and I'm, entering this transaction manually. Now, it might be the case for you when you first deal with your mortgage payment is that, you're starting quick and you've downloaded a bunch of transactions, and the actual, transaction from the bank came through, and it just, maybe said some gobbledygook in the MAC name, like the bank information, or maybe you saw Springside Mortgage, if that's your mortgage company, in there, and you're like, oh, that's my mortgage payment. What do I do with it? So here we go. So if we look at the categories here, by the way, it always comes back to categories when you're making these decisions and how you have those set up. And of course, as I always say, those inform what your report will look like. So we're always kind of looking at those two things. But in my categories under housing expenses, I have a handful of things here, and you might not need all these in the long run, but for illustration purposes, they're here. I have what I call mortgage payment, okay, and that's if you're going to do that first method where you just say out the door, this is my mortgage payment. It's almost as like you're paying rent. Actually, I'm going to put a new category in there called rent too for illustration. Like if you didn't own a house and you just paid your rent, money's all gone. None of it's going into the savings account that's your house. And I would probably use this category, rent, right? I paid my rent. When you pay on your mortgage, we can choose the easy route and just go house mortgage payment. Mortgage payment out, not really worried about the details, blah, blah, blah. But if you're like, hey, I'm neurotic and I want to worry about the details and get it right, or have it, match reality as much as it can, we would go in, edit this transaction, and we'd go to the splits here, and we'd add some splits in. And in the bookkeeping accounting world, this would be called journaling in the detail. What is called splits in Quicken is really like sort of a journal entry system. And this is where we can break down the payment, right, of what's really happening in there. So in this case, let's do an example breakdown here. In this case, we got, we'll start with the interest. We got 1,048.07 going to interest. So if I go to those categories, I got a different category called mortgage interest instead of mortgage payment. I'm going to enter that as negative 1,048.07, right? Because it's money out the door, it's negative. And then as you can see here, we got escrow, taxes and insurance. That's also often commonly referred to as impound. We sent, oh man, I'm sorry, look at this. The 4339, I didn't read this well enough. Yeah, I was like, wow, for this kind of mortgage, it's pretty high. This example statement actually includes like overdue payment on that. We're not going to deal with that. So I apologize. The total of this payment is 1669.71. Okay, so we've changed my total amount here. Back to the breakdown, we got 1,048.07 in interest. We got 235.18 in escrow. And the escrow is interesting. We can do escrow in a couple of ways. I'll explain that too. But for now, I made a category in here called mortgage impound or house impound. Probably should have called that mortgage impound. Let's do that. Let's change that for clarity. Because it is, going out through your mortgage. So we got mortgage impound. And then over here we have principal, okay? And that is basically the amount that's going to pay down your loan. 386.46. You see, as I have my total payment here and I start entering splits, it's always doing the math. I'm down to my last split and it did the math and it equaled this correctly. I made a category called mortgage principal just for illustration service purposes, okay? So I'm going to save that. Now, if I go over to my report and I go down to my housing expenses here, you're going to see now that I have a broken up expense. I got some money went to mortgage interest, some money went to mortgage principal, some money went to mortgage impound, and the total housing expense for now, which just includes these things, is 1669.71, which is the total here. Now, of course, if I had more other housing expenses in there, that total would be different. But in terms of the mortgage in this illustration, it's helpful. Now, you could say what I've done there is really no different than if I just set the whole thing to mortgage payment. Okay. Actually, I'm just gonna duplicate this, and I'm going to make an exact same payment, but I'm gonna get rid of these splits, and we're just gonna go mortgage payment. Okay. save it. And over here in my report, we're going to now see, hey, I got mortgage payment for the whole amount, or, I could do the split up amount. But effectively, those two approaches are the same thing. It's all money out. Nothing has been reflected about the reality that some of my money in that mortgage payment went to my loan, okay? And some of it went to a holding account called the escrow account or impound account, and inevitably will pay my property tax and so on. Like, impound's not a real expense, right? Taxes and insurance are the real expense. So we could have actually said, instead of doing this mortgage impound, right? I could have taken that split. We could get rid of that impound. They call it escrow, and this I call it impound. And if we knew, say, for example, I don't know, $100 of that that escrow payment went to property tax. Okay, let's say it's $150 went to property tax, and then the rest went to insurance. I could do the split that way, and now I would have sort of a breakout for insurance and property tax. However, I don't know exactly what the split is, so there's another way we can do it, which I'm going to show you. So what we reflected here is all money out, and now what we're going to reflect is kind of the reality of the money flow. So this here is still interest. That's always money out. We know that, right? Interest. This here is principal. Instead of putting it to principal, I got an account down here called mortgage, where you can see my balance due equals my balance due here. If I put the principal payment into mortgage, I've now really reflected reality. Okay, I've reduced, you're going to see, I've reduced my balance by the split of that payment. And then also, we're going to go in here and we're going to say, you know what? I don't know what the breakup of the impound or escrow payment is. So I set up an asset account next to my house asset here called impound, and I'm going to send that money over there. And now you see here the impound account added up. But it's like, if I go now to my reporting though, my report stuff, there it is. Now I only have interest over here as expense out, and it looks as though I've spent less money on housing than I did. And this here is the difference between, like, what we call in business, between a cash flow report and a profit and loss. Two things have happened here. The money has gone out. So in real estate terms, my cash flow is negative $1669.71. But I know that because some of that money went to my mortgage account, my actual loss is less than that. It's $1669.71 minus the money that went into my went to pay down my mortgage. And you might be saying, Joe, but you also put money in the impound account, and that money actually is gone because it's going to taxes and insurance. So isn't that not right? And you'd be like, yes, that's true. So what happens with your impound accounts throughout the year, your account piles up with information, with dollars, and then inevitably the taxes get paid, right? So I could say, oh, you know what? Turned out that my tax payment is happening today, and they spent $100. They sent out $100. Sometimes impound accounts pay money towards the tax insurance every month, and sometimes they do one payment per year after it's accumulated enough money. But so either way it works, you end up eventually looking at your escrow statement or impound account statement, and you put in the property tax and insurance payments. And once you do that, Now your report, actually I got to categorize this, excuse me. Now your report will be showing your expense. Property tax, there you go. And here you go. So you can kind of decide like what works for you. And let's say, for instance, you decided, I like, doing it the way you just did it, Joe, where I got the interest goes out, then I put the principal over to my my loan, and then put the inbound in my inbound account. And I know that even though my P&L says I only spent this much in housing, I know cash flow wise, this much money went out the door. But you kind of got to have your mind thinking two things. But let's say, for instance, you like that approach. And you're like, but I don't want to have to put in these splits every time. This is where we would right click in the transaction and we would schedule the selected transaction and we would put in essentially a bill. Because we're memorizing what's already in here, it's already got our splits and it comes out of the account. It's going to come out of it. It's got the net amount. That's all great. Now, the payment method here, just FYI, Quicken combines both bills and income memorization and their bill pay service. I have a whole video talking about the distinction of those things. But some of these things here, like quick pay or whatever, are related to their like bill pay service, which is where if you were to say, hey, I want my bill pay, if I'm using Quicken bill pay, I want you to send the bill out. We're not doing that. So in here, I just say I pay the biller directly. And then it gives you the option here of saying, do I want to enter this transaction in the register like manually, I do it myself, or automatically on the day that I set the schedule up, or before the scheduled date? I always have it going like 10 days before, so it's entering in my register early and I can sort of see some forward-looking cash flow. And over here on the schedule side, I can say, hey, this thing comes out on the 5th of the month, once a month, always, blah, 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 and I hit OK. Now, if I go to bills and income, I got a saved mortgage payment here, and it represents, the exact breakdown the way I want. I will also add, I have it set up to auto enter 10 days in advance. So come January, well, I guess it would be, 10 days before, it would be today, actually. Because I had it go in 10 days and it skipped over, it might not automatically do this first one. But if I enter marked as paid, if I want to do it manually, it's going to show up in here, as in my register, and it's going to have all the splits. Now, back to the options, another way to do this. Because I'll tell you what, like here's the thing. Even though we put this automatic transaction in here, you might be thinking to yourself, but Joe, the interest and principal change every month on a statement. So this automated mortgage payment is not going to be right every month. And you're right, it won't be. But the only way to have it be exactly correct every month is to come do the split yourself every month, which I don't want to do. So what I used to do is I would actually just have, I would take the first of the year statement and put it in that way, and I would just let it do the exact same thing every month. And come the end of the year, my principal and interest were off a bit, and I would do a year-end journal entry to like get that correct and match up with my 1098. I'm going to do another video on how to do that because that's kind of a separate thing. Or the other option is back to what I did originally. What I actually do nowadays is I don't do any splits along the way because I decided I actually kind of want to know more of the cash flow view throughout the year, particularly with my rentals. Like I want to see what the cash flow reality is, because if I were to journal in the amortization every month, I wouldn't be looking at cash flow in my report, but look at P&L. And I kind of want to see the cash flow because that's affecting my day-to-day life, more so than the P&L is. So I just have every mortgage payment automatically go fully to mortgage payment. And then at the end of the year, in that same like tidy up process where I correct things using the 1098, I will journal in the activity of everything for the year through that year-end one transaction process. So I take it was essentially year here of mortgage payments, and I make an adjustment on 12/31, end of year, and I say actually some of this money wasn't, so this mortgage payment was broken up into 4 other things. So I do a journal entry that moves some of the money into interest, some of the money into the impound account, or you could also just, you'll know from your 1098 what your year-end tax and insurance was, and break it up that way, and avoid doing the impound account altogether. And then some of it went to principal, and I, at the year end, do the whole pay down of the principal. So it is a matter of preference and like how much you want to see. If you don't want to deal with any of this, like, house asset mortgage loan, you could just leave it as mortgage payment and call it a day, and then know that in the back of your mind, you're paying down your mortgage and that's going to pay off for you someday. I like to see my mortgage payment, go down against my house asset, because when that's happening, it's affecting my net worth, and it's making my net worth higher every year when I reduce that mortgage liability. So I like to see that. I actually do put the money in the impound account in that year-end transaction, and then in the impound account put in the payment they made to interest and taxes. And that way, kind of like my mortgage, my impound account balance only changes once a year. But like the reason I do it that way is because I like it all to like match up exactly with the 1098. So when I'm done with my year-end journal entry, like my impound account is the right balance, my mortgage amount is the right balance, and of course, everything I've spent out to interest, taxes, and insurance is the right amount on the report. But again, because I'm doing just that flat mortgage payment throughout the year, all year long, I'm seeing sort of the cash flow reality, and only on 12/31, when I put in that little adjustment entry, do I see the profit and loss reality. So that was a little advanced in that we kind of went down into some accounting and, in sort of business accounting. And as, I often say in my videos, you need to treat your personal finances like a business. It's the business of you. So understanding the difference between a cash flow report and a profit and loss report is a great example of something that most people in their personal lives would never even think about. But as you can see here, there is a cash flow and profit and loss distinction reality happening in your personal finances through your mortgage payment. So as you get into managing the business of you do get to understanding like accounting and finance, and then of course financial planning and projecting and tax planning and all sorts of cool things, or at least I think they're cool. So the mortgage payment is a good illustration of more than just the mortgage payment, I guess, is the moral of the story there. So I'm going to end there. That was a lot. I'll talk to you in the next exciting Business of You video. See you later.